To keep yourself updated, subscribe to Indigolearn and click the bell icon.
Hi students, in these modules we'll understand about accounting for bonus issue of shares. Before we jump into the accounting aspects, we need to understand what is the meaning of a bonus issue. Now generally if I ask you issue of shares, what do you understand? You will imagine there are investors, there is a company, the investors pay money to the company and the company issues equity shares to the investors. That is what we understand when we talk about issue of shares. But sometimes what happens is a company may issue equity shares without collecting money from the investors. Sometimes what may happen? The investors may give some other asset. Maybe the company has purchased a building and in return for that they have issued equity shares. Now even in this case, a company is getting some asset from the investor in return for which the company is issuing equity shares. Whether it is a case of issuing shares for cash where a company collects cash and issues equity shares, or sometimes a company may collect or company may get certain assets and the company may issue shares against those assets, or sometimes a company may get service or company may take certain services against which a company may issue shares. Now in all these cases a company is getting something against which a company is issuing equity shares. Now if you come back to the first scenario where a company is getting cash, so what happens? Cash comes into the business, cash, the asset part of the balance sheet, it increases. Correspondingly, issue of equity shares happen, and on the equity and the liability side, you will see the balances rising up. For example, if you collect 10,000 rupees and you issue shares worth 10,000 rupees, assets also increase, liability also increase. So this is generally what happens when we issue equity shares. Now, but when we come to bonus shares, there is a slight difference. In case of bonus shares, a company issues equity shares but does not collect anything from the shareholders. I am repeating once again. In case of a bonus issue, a company will issue equity shares but it will not collect anything from the shareholders. Neither will it collect some form of cash, nor it will collect some other form of asset, nor it is getting any other services. None of this is coming to the company. The company is simply issuing bonus shares, or the company is simply issuing equity shares without any consideration. It is not collecting anything from the shareholders. This is what is called a bonus issue. Now you may have a doubt. If I just issue bonus shares, if I only increase the equity and liability side, how will my balance sheet tally? Now to clarify this, we will take a very small example and understand how this bonus issue actually happens. So in simple words, what's a bonus issue? A bonus issue is an issue of shares without any consideration. Now what does this term consideration mean? Consideration could mean cash, any other form of asset, any other service that has been provided. The company is not collecting or not getting any of these. It is simply issuing equity shares. These kind of issue or such an issue is called a bonus issue. Let us take a small example. We will again follow a T-shaped balance sheet here. Remember, this is not the format for the balance sheet presentation for companies. We are taking a T-shaped balance sheet for our understanding. Now, in this T-shaped balance sheet, imagine there are certain equity shares, 1000 shares of 10 rupees each. So, what does that bring to? The total comes to 10,000. Then you have securities premium that you had collected when you had issued those shares, that is some 5,000 rupees. And then you have balance in profit and loss account, some 10,000 rupees. So 10,000 rupees of equity share capital, 5,000 of securities premium and 10,000 as balance in profit and loss account. Now all these three balances belong to the equity shareholders. It is not just the equity capital, also the reserves and surplus part, that is the securities premium and the profit and loss account. All of these things belong to the shareholders. And corresponding to these equities and reserves, let us say there are net assets of 25,000. So 10,000 plus 5 plus 10, 25, net assets of 25,000. Now when I say net assets of 25,000, what I am referring to is all the assets minus all the outside liabilities. The total figure is 25,000. So I am not showing assets here and liabilities separately here. I am clubbing entirely everything into a single place and the total comes to 25,000. Now this side 25, this side 25, the balance sheet is tallied. Now let us take the first scenario. Let us assume we issued shares for cash. We issued 500 shares at 10 rupees, no premium, nothing was charged, and we collected cash from the shareholders. Now after this transaction is completed, how will the balance sheet look like? The 500 into 10, that is 5,000 rupees, you will increase the share capital. Now the share capital will become 15,000. and on the asset side there will be an increase in bank balance by 5,000. Your net asset will go up from 25,000 to 30,000. The balance sheet remains tallied, right? This is what generally happens when you issue shares for cash. Now we are talking about a case where we are not issuing shares for cash, we are issuing shares for free. So come back to the original example where we had 25,000 on the liability side, 25,000 on the asset side. Now the company is very happy and the company has decided that to all the shareholders, how many shares do we have? We have 1,000 shares of 10 rupees each. To all the shareholders, for every one share, the company will give one share for free. What will the company give? The company will give one share for free. Means what? You will increase the share capital, but nothing will come on the asset side. Money will not come to the company because the company is happy, the company is delighted. It is simply giving shares for free. So now what will happen to the balance sheet? Let us look at this scenario. Now if you look at the first column, the position as on date, equity share capital 1,000 shares at 10 rupees, 10,000. Now after I give shares for free, what will happen? Instead of 1,000 shares, now I will have 2,000 shares because I have given further 1,000 shares and that is for free. So this 10,000 now becomes 20,000. After the bonus issue, it can be seen as 20,000. Is the asset side changing? Asset side is not changing. Asset side remains, the net asset remain at 25,000. Now on the liability and equity side, the equity share capital has now become 20,000. Now if I add 20,000 plus 5,000 of premium what I already have plus 10,000 of profit and loss account what I already have, my balance sheet will not tally because if I am increasing the liability, somewhere either I have to increase the asset or I have to reduce some other liability, correct or not? Unless I do that, the double entry principle will not work and my balance sheet will not tally. So for this, since I have increased this 10,000 of equity capital to 20,000, nothing is changing on the asset side. The only choice I have is from the remaining part in the balance sheet, that is from the securities premium and the profit and loss account, I have to transfer some amount or I have to reduce some amount. So what the law has said is, from securities premium, you can use the amount. So what I'll do, the entire balance of securities premium account, whatever I have, that 5,000 rupees, I will reduce it and I'll make it 0. So now, while I have issued shares worth 10,000, 5,000 is being given by securities premium account. Now what has happened is, I have increased the share capital by 10,000 rupees and 5,000 is being contributed by securities premium. And the balance 5,000 I am removing from the profit and loss account. So now my profit and loss account stands at 5,000. Now look at the scenario. Securities premium now is 0. Profit and loss account from 10,000 has come down to 5,000. Now will my balance sheet tally? 25,000, 25,000. Exactly, it is now tallying. So if you look at this example very carefully, friends, as I told you earlier, this securities premium, this general reserve, these also belong to the equity shareholders. They are a part of reserve and surplus. They also belong to the equity shareholders. What I am simply doing is, from this part which belongs to the equity shareholders, I am transferring a portion to the share capital. What am I doing? The part which already belonged to the shareholders, but it was not shown as equity share capital, that part I am removing from reserves and surplus and I am adding up to the share capital. In this way, a company can issue bonus shares. That's why we call a bonus share issue, or an issue of bonus share is an issue without consideration. The company does not get anything. What is the company doing? Simply on the equity and reserve side, it is just playing around with the numbers. Some numbers it has moved out from securities premium, from profit and loss account, and that number is being added to the equity share capital. Now if you look at it from the shareholders' point of view, earlier, the total shares that the shareholders had was 1,000. After the bonus issue, they will own 2,000 shares. Now, does this mean that the shareholders have doubled their wealth overnight? No, it doesn't mean that. Let's see how does the number play out. If you look at the original scenario, the total of share capital, the securities premium and the profit and loss account was 25,000. This was for 1,000 shares and we can say the book value per share is 25 rupees. Now come to the scenario after the bonus issue. The total is 20,000 of equity share capital, securities premium is 0 and we have profit and loss account balance of 5,000. Now 20 plus 5 makes it 25,000. Now instead of 1,000 shares, I have 2,000 shares in issue. Now what does the book value come to? 25,000 divided by 2,000, 12.5. So see, the moment I made a bonus issue, the book value automatically came down to that extent. When I made this bonus issue, I doubled the number of shares in the hands of the shareholders. But at the same time, the book value of the shares also came down by 50%. So number of shares were doubled, the book value per share came down by 50%, or they became half. Now if you see the total wealth, earlier it was 1,000 into 25, 25,000. Now it is 2,000 into 12.5, 25,000. The total wealth of the shareholders does not change. Similar things happen in the market also. Let's say a company's share is quoted at 100 rupees and the company has come up with a bonus of 1:1. That means 1 share for every share held. The price after the bonus issue will automatically correct to 50 rupees. This is how the price mechanism works. So just because I have given shares for free, it does not mean that the wealth of the shareholders have gone up, right? So this is how the bonus issue actually works. Now a student may have a doubt. Sir, it is the shareholders' wealth, whether I keep it as securities premium, whether I keep it as profit and loss, whether I keep it as share capital, how does it matter? Finally, the shareholder had 25,000 of wealth, now also it has 25,000 of wealth. What is the point in giving bonus shares? Now, there are two large reasons why companies would issue bonus share. The first is, if there is some amount in the profit and loss account, can I pay dividend out of that? Yes, absolutely I can pay dividend out of the profit and loss figure. But once I have issued bonus shares, I have transferred this P&L balance to the share capital. Can I use it for dividend payment? I cannot use it for dividend payment. Now, when such transactions happen, the creditors have comfort on the company, because now they know that earlier 10,000 rupees of P&L balance could have been distributed as dividend, means the company could have paid that money to the shareholders. But now after the bonus issue, 5,000 of that is already locked. The company cannot touch that amount, which means the creditors have higher security. They have higher faith in the business of the company. That is one reason. The second reason is, the moment I make bonus issue, the share prices, as I discussed, it comes down to some extent. For example, if it is a 1:1 issue, the share price actually becomes half. Now when the share prices become half, it is easily accessible to large number of shareholders or large number of investors who want to buy the shares of the company. Now a classic case here, if you would like to read, you can search for the Wipro case, where 10,000 rupees invested way back in 1980s have become hundreds of crores now. A large part of it is because of bonus issue. Even today, Wipro share is available at a reasonable price. Had they not made those bonus issue, a common man like you and me would not have been able to purchase such shares, because it would be quoted at maybe a lakh rupee or a 2 lakh rupee if there were no bonus issue. Another example that we can take is that of MRF tires. MRF tires, the shares are quoted at about 60,000 rupees. Now, a common man, a person who is maybe earning 40,000 or 50,000 a month, may not be able to put in 60,000 at once to buy one share of MRF. But imagine if MRF says, for every 1 share, I'll issue 9 more shares. That means 1 share now becomes 10 share. That 60,000 price comes down to 6,000. It becomes available to more and more people. The availability of shares increases. The liquidity in the shares increases. So it is a management call. Do they want more and more shareholders or more and more people to purchase those shares? Then definitely they may consider, using the bonus issue. Or if they feel that no, I don't want to, reduce the value, I don't want to keep the value of my shares lower, I want the value of the shares to keep on rising, that is another stand companies can take, where the shares will not be available to many public shareholders. So these are the two large reasons which may decide whether the company wants to issue bonus shares or not. Another thing that you need to notice, whatever is the profit portion that we have transferred to capital account, to that extent, the shareholders will no longer be receiving dividend. The company will keep that money within the company, right? This is another factor which the company might consider to issue bonus shares. Whether they want to pay dividends out of the profit and loss balance, or whether they want to keep the profit and loss balance with the company, capitalize that profit. That means issue equity shares against the profit and loss balance and keep the money within the company. Do they want to distribute dividends or do they want to retain the profits within the company? This is another factor what companies or management might think whenever they are deciding about bonus issue. So in a nutshell, what is a bonus issue? A bonus issue is an issue of shares without consideration. And how are they funded? Some part of the reserves will be used to create that share capital. Let's look at another illustration. Following is the extract of balance sheet of Solid Limited as at 31st March of year 1. Authorized capital 10,000 12% preference shares of 10 each and 1 lakh equity shares of 10 each. Issued and subscribed capital 8,000 12% preference shares of 10 each fully paid up, that comes to 80,000, and 90,000 equity shares of rupees 10 each, 8 paid up, comes to 7,20,000. Reserves and surplus, general reserve, revaluation reserve, securities premium collected in cash, and profit and loss account 2,05,000. Now out of these four, when you are reading the question itself, you should be able to figure out that revaluation reserve cannot be used, but can you use securities premium account? Definitely yes, because they have clearly mentioned it is collected in cash. Okay, if it is a private limited company and I have collected securities premium not in cash, can I utilize it? Absolutely yes, because a private company cannot be listed and SEBI rules will not be applicable. Okay, then secured loan 12% debentures of 100 each, 5 lakhs. On 1st of April of year 1, the company has made final call of 2 rupees each on 90,000 equity shares, and the call money was received by 20th April of year 1. Now, one important point to understand here is, we clearly know that if it is unpaid, if it is not fully paid up, we cannot issue bonus shares on such shares. And we said two options are there. Option number 1, you collect the amount in cash from the shareholders. Second option is you can use the free reserves and adjust the final call. Now in this case, the company has made a final call and the final call money has been received on 20th of April. Thereafter, the company decided to capitalize its reserves by way of bonus at the rate of 1 share for every 4 shares held. So again here you will get 1 bonus share for every 4 shares held. Show necessary journal entries in the books of the company and prepare the extract of the balance sheet immediately after the bonus issue, assuming that the company has passed necessary resolution at the general body meeting to increase its authorized share capital. Now, why is the need to increase the authorized share capital? We'll come to it when we are solving the problem. What are the two requirements? Pass the journal entries and show the extract of balance sheet. Now, they have also given us an extract of balance sheet. So, we have to show the extract of balance sheet in the solution. Now, whenever they say extract of balance sheet, please ensure balance sheet extract plus notes to accounts, right? So, we need to pass journal entries right from the making of final call, receiving of the call amount, then issuing of bonus shares or transferring the reserves to the bonus to shareholders account, and finally allotting the bonus shares. Now, let us pass journal entries as asked by the question. What is the first thing that has happened? Before the bonus issue, the company has made a final call. Now, final call on how many shares? Final call on 1 lakh shares or 90,000 shares. Now, if you carefully look at the question, authorized capital is 1 lakh, but issued and subscribed capital is only 90,000, which means you will make the final call on 90,000 only. What will be the entry for that? This is year 20x1, that is the first year. On April 1st, equity final call account debit, right? By how much? 90,000 into 2. So, this will be give you 1,80,000 to equity share capital 1,80,000. Narration being final call on 90,000 equity shares at rupees 2 per share. Now, this is the entry for final call. When did the amount come? If you look at the question, the shareholders paid the amount on April 20th. So, on April 20th, bank account debit 1,80,000 to share capital or equity final call, to equity final call account 1,80,000 being final call amount received. Now, after the final call amount has been received, we have 90,000 fully paid up shares and we are issuing bonus shares at what rate? 1 share for 4 shares held, which means how many bonus shares will be issued? 90,000 divided by 4, because for every 4 you are issuing 1 bonus shares. So the total number of bonus shares that will be issued is 90,000 divided by 4, that comes to 22,500. Still we will indicate that in a working note. Working note number 1, number of bonus shares, to be issued. How much is that? 90,000 divided by 4. So 45,000 by 2, that makes it 22,500. Value of bonus shares will be 22,500 into 10, that is 2,25,000. So you will have to create, or you will have to credit the bonus to shareholders account by this 2,25,000. So on the same date, that is on April 20th, so you will have to credit to bonus to shareholders. I am writing short form SH, but in examination please write the full word, that is shareholders. To bonus to shareholders account, what is the amount? We just now computed 2,25,000. Now, if you look at the question, what all can you use? You can use general reserve, you cannot use revaluation reserve, you can use securities premium, and you can use P&L account balance. So first let us exhaust the securities premium account balance. Securities premium account. Securities premium account, what is the balance? 20,000. Then general reserve. General reserve is 1,60,000. So 1,60,000 plus 20, 1,80,000. You have 2,25,000. So what is the shortfall? 45,000. That you can utilize from the profit and loss account. So profit and loss account 45,000. Now with this entry, when you are preparing the extract of balance sheet, please remember to adjust these amounts when you are preparing the notes to accounts. Okay. So what is the narration for this? I will write in a different color. Being issue of 1 bonus share for every 4 shares held. Right? Then after you have made this entry, the next entry is pretty simple. Transfer the amount lying in the bonus to shareholders account to the share capital account. So on April 20th, bonus to shareholders account 2,25,000 to equity share capital 2,25,000. So what we have done, we have transferred this credit amount to the equity share capital account. Now if you see the entry, if you combine both these entries, this bonus to shareholders and this bonus to shareholders account, they get knocked off. In other words, these 3 accounts are being debited, this account is being credited. You are transferring these numbers from the different reserves account to the equity share capital account. Now that we have passed the journal entries, let us prepare the extract of balance sheet. Now, what is the information given in the question? We have information of capital issued, reserves in surplus and secured loans, which means we will need to give the extract for these three items only. You are not required to give the extract on the asset side because you do not have the complete information. So if you look at the balance sheet on the equities and liabilities side, under shareholders fund we have share capital. For this we know we will need to prepare a note number 1. So coming to the notes to accounts, note number 1, share capital, right? Now under share capital we have two categories. One is the preference share capital, then the equity share capital. Now we'll need to present the information of the authorized share capital, issued and subscribed share capital. So you can do either based on, first you can say equity share capital, what is the authorized and what is the issued portion, or you can say what is the total authorized capital and then you can say what is the total issued capital. So let's follow the second approach. Authorized. What is the authorized capital? Now as per the question, authorized capital for equity shares is 1 lakh equity shares of rupees 10 each. But friends, if you look at the workings that we have done, we have already issued 90,000 shares and we have further issued bonus shares of 22,500. So 90,000 plus 22,500 makes it 1,12,500, correct? Now this 1,12,500 is more than the authorized capital. The issued capital is now becoming more than the authorized capital, and in the question they have clearly mentioned that necessary resolutions have been passed to increase the authorized capital. Now what is the authorized capital required? Issued capital is 1,12,500 shares, right? 90,000 of the original shares and 22,500 of the bonus issue. So you need authorized capital to be at 1,12,500. If that is the case, it is sufficient. You can have an amount even higher than that, but 1,12,500 is the basic minimum that you need. So authorized capital 1,12,500 equity shares of rupees 10 each. So 1,12,500 into 10 makes it 11,25,000. Then preference shares, do we need to make any changes? We don't need to make any changes. 10,000, 12% preference shares of rupees 10 each. So 10,000 into 10, 1 lakh. So 11,25,000 plus 1 lakh, you have 12,25,000. Now this particular 12,25,000 will not impact your balance sheet, right? Then coming to the issued, subscribed and paid up. Issued, subscribed and paid up. How many equity shares? 90,000 original equity shares plus 22,500 bonus shares. That makes it 1,12,500 equity shares. So 1,12,500 equity shares of rupees 10 fully paid up. That makes it 11,25,000. One important point you need to write is, what is that proportion of bonus issue? How many shares you have issued by capitalizing profits? That has to be clearly mentioned, because remember friends, there has not been any consideration received for this bonus shares, and that fact has to be disclosed separately. So we will say, out of above 22,500 equity shares were issued as bonus shares, right? So you need to mention that these many shares have been issued as bonus shares, so that the reader of the financial statements know that so many shares have been given away without getting any consideration. Then we have preference shares. How many preference shares? 8,000 preference shares. So 8,000, 12% preference shares of rupees 10 each. 8,000 into 10, 80,000. So 11,25,000 plus 80,000, the total becomes 12,05,000. 12,05,000. So this 12,05,000 is what you will plot in the balance sheet. So come to the balance sheet. 12,05,000, right? Then the second item that we need to fill is the reserves and surplus. For this we will prepare a note number 2. Reserves and surplus. Now, coming back to the question, we have general reserve of 1,60,000. General reserve, you had 1,60,000. Entire thing is used for bonus. Entire thing is used for bonus. So 1,60,000. Yeah, left with nothing here. The second item in the question you have is the revaluation reserve. Now in the revaluation reserve, the amount given is 35,000. There is no change, right? Then the third item is securities premium collected in cash. So you can just say securities premium. What is the amount? The amount as per the balance sheet is 20,000. And if you look at the journal entry that you have just passed, you have utilized 45,000 of that. So less used for bonus 45,000. 2,05,000 minus 45,000, 1,60,000. So 1,60,000 plus 35,000, you have a total here of 1,95,000. This is what you will put in the balance sheet. 1,95,000. Then we have details regarding secured loan, 12% debentures of 100 each. Did anything happen to this number? Nothing happened. But since we have the information, we will need to present it in the balance sheet. So under long term borrowings, you will have note number 3, long term borrowings. Whether it is secured or unsecured, it is secured. 12% debentures of rupees 100. What is the number? The number has not been given, but we can mention 5,000. 5,000, 12% debentures of rupees 100 each. That comes to 5 lakhs, right? Now this 5 lakh will be plotted in the balance sheet. So come to the balance sheet. Here you will mention 5 lakhs. What is the total? 12,05,000 plus 1,95,000. That makes it 14 lakhs plus 5 lakhs. You have a total of 19 lakhs. This is the total of the equities and liabilities on the balance sheet side with whatever information we have in the question. So whenever a question asks you to prepare balance sheet, the most important thing is not just putting the information, using the correct format. For what all items we need to show the notes to account, where we need to disclose. Whenever we are making a bonus issue, we need to make a separate disclosure. So all those things have to be disclosed carefully so that you will get full marks. It is not about putting the information. Information is already available. How do you put it in the right format is very important. Let us look at an illustration. Following items appear in the trial balance of Bharat Limited as on 31st of March of year 1. Now, why have they specifically given a listed company? Now friends, we have discussed the provisions of Companies Act, we have discussed the provisions of SEBI. SEBI provisions are applicable only to the listed entities, whereas Companies Act provisions are applicable to both listed and unlisted entities. Now one peculiar thing about SEBI regulation is they have specifically told even securities premium have to be realized in cash. You know the thing that we were discussing earlier that securities premium has to be realized in cash. SEBI provisions make it very clear that securities premium has to be realized in cash, only then you can use it for bonus issue. Whereas Companies Act do not make that specific mention. The Companies Act nowhere specifies that securities premium also has to be collected or realized in cash. So what is the SEBI provision? SEBI provision is that securities premium must be realized in cash. If it is a listed company, this provision applies, and if securities premium is realized in cash, only then you will be able to use it for bonus issue. Whereas if it is an unlisted company, even securities premium collected other than in cash can be utilized. Generally what I would suggest is, if the question mentions specifically listed, unlisted, it is fine. But if the question is silent about that, and if they say that securities premium is not realized in cash, how do we deal with that? You make an appropriate note. Either you assume that it is a listed entity and securities premium not realized in cash cannot be used, or it is an unlisted entity and securities premium not realized in cash can be used. Either ways the assumption works perfectly. So you have to make your proper assumption, you have to state that assumption in your answers, right? But general rule is, if it is a listed company, it is governed by SEBI and securities premium must be collected in cash. Okay, so the balance sheet is given 40,000 equity shares of rupees 10 each, 4 lakhs. Capital redemption reserve 55,000. Now as you read the question, you must be able to understand, or you must be able to decide, can I use this balance? Can I use the CRR balance? Absolutely yes. Then securities premium collected in cash, they have given that it is collected in cash, 30,000. Then general reserve 1,05,000. Can I use general reserve? Yes. Surplus, that is credit in the profit and loss account, 50,000. Can I use it? Absolutely yes. The company decided to issue to equity shareholders bonus shares at the rate of 1 share for every 4 shares held. What did they do? 1 share for every 4 shares held. That means if you hold 4 shares, you will get 1 additional share. Now this ratio is also represented as 1:4. How is that? 1:4. 1 share for every 4 shares held. So in the examination, either they will give you a statement or they might give you a ratio itself. And what is the ratio? 1:4. What does that mean? 1 share for every 4 shares held. Okay, then, and for this purpose, it decided that there should be minimum reduction in free reserves. And friends, generally when we solve bonus issue related question, we will try to ensure that the adjustment or the reduction in the free reserves should be the minimum. First you should utilize securities premium, CRR, and then only you should think about PNL or other free reserves. Pass necessary journal entries, right? Now it's a very simple question, very straightforward question. It's a listed company, so SEBI Act is applicable, where they have clearly mentioned securities premium must be realized in cash. If it is an unlisted company, you may have securities premium, even if it is not realized in cash, you can use it, right? Now in this case, because they have mentioned it clearly, our work becomes easier. Now 2 things to be done here. First, you need to identify what are the number of shares to be issued. That is the first thing. Then second thing that you need to do is, what are the balances you will be using, and then come to passing of entries. See, once you have computed the number properly, and then secondly you have identified the sources, it becomes easier to solve these problems, right? Firstly, let us figure out what are the number of shares which will be issued as bonus shares. So what you will do is, you will prepare a working note number 1, number of shares to be issued, right? What does the question say? 1 share for every 4 shares held, which means if your existing shares are 4, bonus shares will be 1. Now how many existing shares are there? 40,000. Are they all fully paid up? Yes, 40,000 into 10, 4 lakhs. They are fully paid up. So you have 40,000. How much will be the bonus share? Now in this case, it's straightforward. If 4, it becomes 1, 40,000 will become 10,000, or you can do a simple cross multiplication. That is 40,000 into 1 divided by 40, you get 10,000 bonus shares. Now these 10,000 bonus shares, when you are making the issue, we said you will be issuing it at face value. So 10,000 at rupees 10. So value of bonus issue will be 1 lakh. Value of bonus issue will be 1 lakh. Now this is what we will use to pass the journal entries. So when you pass the journal entries, make sure you have the proper format, the date, particulars, debit and credit columns. I'm just writing the journal entries, you can write down in the proper format. Now we know we have to issue bonus shares of rupees 1 lakh. So we will simply say to bonus to shareholders 1 lakh. Bonus to shareholders 1 lakh. You will credit this account, bonus to shareholders account, with the bonus issue amount, that is 1 lakh. Now to issue this bonus or to make this bonus issue, you can utilize which all account? You can utilize the CRR, the securities premium which is collected in cash, general reserve and the surplus in the P&L. But what is the order? First you should try to finish off the CRR and securities premium account. So what we'll do? Capital redemption reserve debit. Debit by how much? What is the balance in the question? 55,000. So I can utilize only 55,000. Next I'll target the securities premium account. Securities premium account debit by 30,000. So 55,000 plus 30,000, 85,000. I have a total credit of 1 lakh, which means there is a shortfall of 15,000. 1 lakh minus 85,000, there is a shortfall of 15,000. Now this 15,000 I can utilize it from the general reserve. So general reserve account balancing figure 15,000. Now a question may come to your mind, can I use profit and loss account first? Now generally if you see the order from transferring out of general reserve to pay a dividend, again there are certain restrictions. So what you need to ensure is, first you knock off CRR and securities premium, then you target the general reserve, then you touch the P&L account. That should be the order you should be following whenever you are making a bonus issue. So what is the narration for this? Being bonus issue at the rate of 1 share for every 4 share held. This is the first entry. Now when you make the allotment of this, what you will do is, you will debit this bonus to shareholder account and you will credit the equity share capital account. So the second entry, that is the allotment entry, will be bonus to shareholders account debit 1 lakh to equity share capital 1 lakh, right? Now the narration being bonus shares allotted. Now friends, this allotment of bonus shares, whenever you are using the reserves and you are transferring that to the capital account or to the share capital, is also known as capitalization of profits. What is it called? Capitalization of profits. So these are the two entries that you need to pass for this question, and now this question may come in the examination for 4 or 5 marks. Let us now discuss some of the provisions of the Companies Act and also provisions of SEBI or regulations of SEBI which deal with the bonus issue, right? The first thing we need to understand is, what are the reserves the company can use to create or to issue bonus shares, right? Now this is dealt by section 63, which clearly says bonus issue can be made out of free reserves, securities premium account balance, capital redemption reserve. So these are the 3 reserves which a company can use to issue bonus shares. What are they? Free reserves. Now, what is the meaning of free reserves? Simply put, these are the reserves which are available for distribution as dividend. Maybe your general reserve, maybe your profit and loss account balance, which are free, which are not apportioned or which are not appropriated for a specific purpose, right? These reserves are free. Then the second one is securities premium account. So whatever securities premium you have collected at the time of issue of shares or issue of debentures, that can be used to issue bonus shares. The third is capital redemption reserve balance. Now, where does the CRR come? It will come when you redeem the preference shares or there is a buyback of equity shares. So, whatever is the balance in the capital redemption reserve account, even that can be used to issue bonus shares. Now, can I use debenture redemption reserve? I cannot use debenture redemption reserve because that is not a free reserve. It is kept aside for redemption of debentures. So, you must keep in mind free reserves, securities premium account balance and capital redemption reserve. These three reserves can be used to issue bonus shares. Now, when I say these three reserves can be used, if you see, these three reserves will have credit balance. With that balance, I will transfer some portion and I will issue equity shares. So, I will reduce these three balances and issue equity shares, right? So, that is what is meant by using of reserves for issue of bonus shares. Now, one thing that you need to understand is, if you have revalued certain assets, let's say your property, plant and building at 1 lakh, you want to revalue it and make it 1,50,000. Now, when you make it 1,50,000, that 50,000 will be shown as revaluation reserve. Now, the Companies Act is very clear that this revaluation reserve cannot be used to issue of bonus shares, or this revaluation reserve cannot be used to issue bonus shares. So, what are the three reserves which can be used? All free reserves, securities premium account and capital redemption reserve. What cannot be used? Revaluation reserve cannot be used. Any specific reserve like debenture redemption reserve, even that cannot be used to issue bonus shares. Now, in examination, what you need to do is you have to figure out what are the balances or what are the reserves which are available for issue of bonus shares, and then you have to choose an order in which you want to utilize. See, you would like to touch the free reserves at the last because free reserves can be used to pay dividend. Securities premium cannot be used to pay dividend. Capital redemption reserve cannot be used to pay dividend. So, these kind of reserves you would like to utilize first and you will come to the free reserves at the last. Another thing that you need to note about free reserves is if it is on account of changes in fair value of assets and liabilities, or if it is unrealized, even such kind of gains or such kind of balances cannot be used. So, free reserve completely means something which is available for distribution as dividend. Only that balance can be used to issue equity shares. Now, this is on which balances to use. The next thing is, what is the procedural part? How should a company approach, or how can a company issue bonus share? What is the process that it has to follow? The first and foremost thing is it has to be authorized by the Articles of Association. So, the Articles of Association must have a specific clause in this regard saying that the company can issue bonus share. The next thing is the board must recommend issue of bonus share. In other words, the board must approve this issue of bonus share. The board meaning board of directors. Then third, the shareholders must approve it in a general meeting. So, only after these three things, one is the authorization by Articles of Association, second is the recommendation by board of directors, the third is approval by shareholders in a general meeting. After these three only a company can issue bonus share. Apart from these, the company must also satisfy certain conditions. The first condition is it must not have defaulted in payment of interest or in repayment of principal in respect of certain fixed deposits or any other debt securities issued by it. Now, what does this mean? If a company has issued some debt securities, let's say it has issued debentures, and on that if it has defaulted in payment of interest, then in such a case that company cannot issue bonus share. The second one talks about it has not defaulted in payment of dues related to employees. For example, there is a provident fund contribution and the company has defaulted in that contribution payment. In such a case, the company cannot issue bonus share. And the third one being, a company cannot issue bonus shares on partly paid shares, meaning to say if you have to issue bonus share, you have to convert that partly paid shares into fully paid shares. So only when these three are satisfied, you can go ahead and make a bonus issue. On the approval part, articles of association, recommendation by board, and approval by shareholders in general meeting. Then you should not have defaulted in interest and principal payment. You should not have defaulted in employee dues, and you cannot issue bonus shares on partly paid up shares. So now, what are the balances that can be used to issue bonus shares? Free reserves, securities premium, capital redemption reserve, right? These are the three balances which can be used to issue bonus shares. Now we also said that you cannot issue bonus shares if the shares are not fully paid up. Means first you have to convert the partly paid up shares into fully paid up shares, and then you can issue the bonus shares. Say for example, a company has 1000 shares in issue which are of face value 10 rupees, but currently paid up to the extent of only rupees 5. So face value is 10 rupees, paid up value is 5 rupees. So what is the amount that would be shown in the share capital? 1000 into 5, 5000. Now before you issue any further bonus shares, or before you carry on the activity of issuing the bonus share, this 5000 of partly paid up shares must be fully paid up or must be converted into fully paid up. Meaning to say, either you ask the shareholders to pay that 5000 rupees which is pending, so that the entire shares now become fully paid up. That is one option. Or the second option that is available to the company is, out of these free reserves, only out of this free reserves, it can utilize that 5000 rupees and convert these partly paid up shares into fully paid up shares. In other words, to convert the partly paid up shares into fully paid up shares, a company can use its free reserves. It cannot use the capital redemption reserve, or it cannot use the securities premium account. These two accounts cannot be used to convert the partly paid up shares into fully paid up shares. But the free reserve balance can be used to convert the partly paid up shares into fully paid up shares. So when you say you can use the free reserves to convert the partly paid up shares into fully paid up shares, what you are doing is, from the free reserves account, you are transferring, or you are removing 5000 rupees of balance and you are adding that to the share capital account. So you can use free reserves to convert the partly paid up shares into fully paid up shares. But for bonus issue, you can use all the three balances, and the securities premium and the CRR balance cannot be used to convert the partly paid up shares into fully paid up shares. And one last thing, after a company has made an announcement of a bonus issue, means you have been authorized by the articles, the board have recommended, the general body meeting has approved it. After you have made the announcement and the company has come out and made an announcement that we will be issuing bonus shares, because after you have made an announcement, it shows a lot of confidence of the management on the company, and once you have made that announcement, you cannot go back and say I will no longer issue this bonus shares. So once announced, it has to be implemented, right? So this is the brief about the provisions as per the Companies Act. Coming to rules and regulations framed by SEBI, they also largely talk in similar lines of what is given by the Companies Act. In addition to whatever we discussed, it has a special point regarding compulsorily convertible debentures. Now, what are these compulsorily convertible debentures? Let us say a company has issued, let's say 100 debentures. Now, these 100 debentures at a specified date or at a future date will have to be compulsorily converted into equity shares. It has to be converted into equity shares. Now for these 100 shares, these debenture holders will get 1000 equity shares, and it has to be compulsorily convertible. It is not an optional thing. Now if such a scenario already exists, if there are outstanding compulsorily convertible debentures, what SEBI says is, when you are making a bonus issue, you have to reserve a portion of bonus issue even for this compulsorily convertible debentures. Now, why is it so? Let us say today I bought a debenture, or I bought this 100 debentures thinking that I will get 1000 equity shares at a future date. But the company in between came up with a bonus issue. It issued one share for every share existing, which means the value of shares have come down to half of the original value. Now in that case, these 1000 shares are now worth only 500 shares for me. So what SEBI says is, if there are outstanding compulsorily convertible debentures what you have to ensure is for these 1000 shares which will be given to those debenture holders, you reserve 1000 shares as bonus issue, meaning to say a part of the bonus issue must be reserved for this outstanding compulsorily convertible debentures. Only then you can make a bonus issue. So if I am holding those 100 debentures, when I convert those debentures, I'll actually get 1000 shares plus 1000 bonus shares, in total 2000 shares, and hence I will not be at any loss. On timelines, what SEBI regulations say is, once the board of directors have taken the decision to issue bonus shares, if they do not need shareholders approval, so maybe in the articles of association itself they have mentioned that bonus issue does not require shareholders approval. If that is the case, within 15 days of the decision, the bonus issue must be completed. In other cases where you have to go and take shareholders approval, the bonus issue must be completed within 60 days. So these are the timelines which have been prescribed by SEBI. And SEBI also says that once you have made a bonus issue or once you have made an announcement of bonus issue, you cannot withdraw that announcement. Now, to quickly summarize or revise whatever we have discussed so far, we said we will issue bonus shares without any consideration, meaning to say there will be no change in the asset side of the balance sheet. Whatever game we are playing only on this equities and liabilities side. Now, whenever we are issuing bonus shares, we can utilize the balances in securities premium account, CRR, profit and loss account, general reserve. Now this profit and loss account and general reserve are also called as your free reserves. I cannot utilize DRR. I cannot utilize revaluation reserve. The other thing that you need to keep in mind is, even on this profit and loss account and general reserve thing, you have to realize the profits. It cannot be out of change in fair value adjustment. It cannot be something which is artificial or something which is not realized. Similarly, even securities premium account, this you must have collected in cash. Only if you would have collected in cash, you can utilize this balances, right? So we cannot use DRR, we cannot use revaluation reserve. This is very clear. We can use other balances. Now, when I use these other balances, I am adding the balance to the equity share capital account. Please remember friends, bonus issue does not happen at a premium or at a discount. Anyways, discount on issue of shares is not at all allowed. The issue of shares, when you are doing bonus issue of shares, it is not that you are issuing something at premium. Whatever is being credited to the equity share capital account will be at the face value, right? Now, how do we pass the entry for, or how do we do the accounting for bonus issue? We all know we have to increase the share capital account and one of these balances will be reduced, correct? So, if you have to reduce this balance, if you have to reduce securities premium balance, or if you have to reduce the P&L balance, what would you do? They are on the liability side, they have a credit balance. To reduce the credit balance, you will debit those accounts, correct or not? So what will you do? You will say securities premium debit, CRR debit, profit and loss debit, general reserve debit. All these accounts you will debit. By what amounts? That will depend on the question. When we discuss specific questions, we will see what amounts to be used or by what amount should we debit these accounts. But these 4 accounts will be debited and you will credit an account called bonus to shareholders, right? Now, you debited these 4 accounts and you will credit bonus to shareholders. Then, when you make that allotment of bonus shares, you will debit this bonus to shareholders account and credit your share capital account. So, what will be the second entry? It will be debit bonus to shareholders, credit share capital, or crediting equity share capital. So, what will be the entry? Bonus to shareholders account debit to equity share capital account. This is when you have made the bonus issue, right? Now, sometime back we also discussed that you can utilize the free reserves, that is the P&L balance and the general reserve balance. This can be utilized to convert the partly paid shares into fully paid shares. Now we will see what will be the entry for that. So when you have to convert the partly paid shares into fully paid shares, you will again debit profit and loss account and general reserve and you will credit bonus to shareholders. Bonus to shareholders. Now you are converting a partly paid shares into fully paid shares. In other words, you will have to make a call, right? You will have to make that final call so that the call becomes due. So what is the entry for that? You would have already learned at a foundation or CPT level. Whenever you make the final call entry, you will debit share final call and you will credit equity share capital, right? Then when you utilize the general reserve and profit and loss account to convert these shares, the entry for that will be debit bonus to shareholders, credit share final call, right? Now what have we done? We have utilized the profit and loss and general reserve balance and we have created something called as bonus to shareholders. This bonus to shareholders balance, we have utilized it to adjust the final call. In general circumstances, what would have happened? After you have made the final call, you would have received the money in cash or bank. So you would have said bank account debit to share final call. But here instead of saying we have received in bank, you're saying you're utilizing that bonus component. So you'll debit bonus to shareholders and you'll credit the share final call account. This is the logic of entries that will flow in all the problems that we will be dealing in this chapter. We'll take problems and we'll see what is the order of utilization of balances, what is the amount of bonus issue that can be made, and how do we understand the ratio of bonus issue. Even that we will understand.